Think your savings are safe in the bank? Think again, because what you're about to hear may completely change the way you look at your finances. While we trust our banks with our hard-earned money, most of us don't realize what's happening behind the scenes. How our savings are being used, what protections are actually in place, and the silent threats quietly eroding the value of our wealth every single day. Let's start by unpacking one of the biggest illusions in modern finance, that your money sitting in a bank account is perfectly safe. Now, don't get me wrong, banks play a vital role in our economy. But the full picture of how they operate? That's something very few people truly understand. And frankly, it's something the banking system doesn't want you to think too deeply about. You've probably heard of the FDIC, right? The Federal Deposit Insurance Corporation is the safety net we all count on. If a bank fails, FDIC insurance is supposed to cover your money, up to a limit. But here's where it gets tricky. That limit? It's currently $250,000 per depositor, per bank. That sounds like a lot until it's not. Imagine you've worked for decades, saved diligently, and finally have $500,000 sitting across a couple accounts. You think you're diversified? Maybe even clever. But if all those accounts are under the same bank and tied to your name alone, only $250,000 is insured, the rest vulnerable. Now multiply that vulnerability across tens of millions of Americans who don't realize this. The truth is, if your bank fails and you've got more than the insured limit in your account, the rest could vanish. You might get some of it back in time, maybe, but there are no guarantees. And here's something else. The FDIC itself doesn't have enough money to bail out every depositor in the country if multiple banks were to collapse at once. In fact, the insurance fund only holds a fraction of the total deposits it's supposed to protect. So if there's a widespread banking crisis, the FDIC might be forced to rely on emergency funding, or worse, prioritize who gets bailed out and who doesn't. Now you might be thinking, well, that's a rare scenario. Banks don't fail that often. But let me remind you, we've seen it happen before. Think back to 2008. Think back to Silicon Valley Bank in 2023. Think about the cracks that appeared in the system. Cracks that most people didn't see until it was too late. When confidence in banks drops, panic spreads fast. And in today's world of instant online banking, money can be withdrawn with a few taps. Bank runs no longer require standing in long lines. They happen digitally and they happen fast. And that brings us to the engine behind modern banking, fractional reserve banking. This is the part banks really don't want you to think about. When you deposit your money in a bank, you probably assume it's just sitting there, safe and untouched, waiting for you to withdraw it. But that's not how it works, not even close. Banks are legally allowed to keep only a small portion of your deposit, sometimes as little as 0 to 10%, and lend out the rest. This is fractional reserve banking in action. For every dollar you deposit, the bank may lend out 9. That money gets loaned to others who deposit it again, and then that gets loaned out again. Creating a multiplier effect, your single dollar essentially fuels the creation of many more. Sounds efficient, right? But it's also incredibly risky, because it means banks don't actually have the money on hand if everyone wanted to withdraw at once. They're relying on the assumption that most of us won't need our money all at the same time. When confidence is stable, the system works. But the moment there's fear or panic, the whole thing teeters on the edge. Suddenly, your safe deposit becomes not so safe. Let's not forget inflation, the silent thief. Even if your money is technically safe in a bank, what is it worth? Inflation erodes the purchasing power of your money year after year. It's the reason a dollar today buys less than it did 10 years ago. And with recent inflation rates spiking beyond historical averages, that erosion is happening faster than many expected. Let's put this in real terms. If you've got $100,000 in a savings account earning 1% interest, but inflation is running at 5%, you're losing 4% of your purchasing power annually. Over time, that adds up, and while banks offer interest, it's often not enough to keep up with inflation. So while your balance might be growing slowly, its actual value is shrinking quietly in the background. So where does that leave us? If banks are lending out your deposits, FDIC insurance has limits, and inflation is eating away at your savings, what's the solution? That's where alternative assets come into the conversation. I'm talking about gold, cryptocurrencies, real estate, and even precious metals. These aren't traditional banking products, but they've become essential tools for those looking to diversify and protect their wealth. Let's start with gold. For thousands of years, gold has been a store of value. It's tangible, it's limited, and it doesn't rely on a central bank. During times of crisis, whether it's inflation, war, or banking instability, gold has historically retained its value and often increased. That's why so many savvy investors keep a portion of their wealth in physical gold or gold-backed ETFs. Now, gold isn't perfect. It doesn't generate income. It can be bulky to store securely, but it's a hedge, a counterbalance to the risks of fiat currency and banking volatility. And then there's crypto. Cryptocurrency, the controversial newcomer. But love it or hate it, crypto is changing the game. Bitcoin in particular was born out of the 2008 financial crisis as a decentralized alternative to the traditional financial system. It's limited in supply, not controlled by any government, and offers a way to hold and transfer value outside the banking system entirely. Sure, it's volatile. Yes, it's speculative. But it also offers a degree of sovereignty over your money that traditional banks simply can't. If you own Bitcoin and store it securely, no bank, government, or third party can touch it without your permission. That's powerful. Of course, alternative assets aren't for everyone. They require education, due diligence, and risk management. But the point is this: true financial safety doesn't come from blind trust in banks. It comes from understanding the system, knowing its limitations, and diversifying intelligently. So what should you do right now? First, audit your own finances. How much of your savings are above the FDIC insurance limit? If you're above that $250,000 threshold, consider splitting your funds across multiple institutions or titling accounts differently, like with joint ownership, to increase coverage. Second, educate yourself on fractional reserve banking. The more you understand how banks operate, the more equipped you'll be to make strategic decisions about where and how to store your money. Third, start learning about alternative assets. You don't need to jump headfirst into crypto or buy a vault of gold tomorrow, but explore. Understand how they work. Understand how they don't work. Then decide what role, if any, they might play in your financial strategy. And finally, ask questions. Don't just assume your bank has your best interests in mind. Read the fine print. Know the terms. Know the limits. Because at the end of the day, nobody cares about your money more than you do. It's time to take responsibility. It's time to stop blindly trusting the system and start playing offense instead of defense. Because yes, your money can be safe, but not if you leave it all in one place, earning next to nothing, vulnerable to systemic risks that most people don't even think about. Now let me leave you with this. Money isn't just numbers on a screen. It's your effort, your sacrifice, your future. You owe it to yourself and your loved ones to understand how the system works and how to protect what you've built. So, is your money safe in the bank? Maybe. Maybe not. But now at least, you know the truth about what banks don't want you to know. If you found this breakdown valuable, leave a comment below. What shocked you the most? Hit that like button if you're rethinking your savings strategy right now, and don't forget to share this video with a friend who needs to hear it. For more daily insights to help you protect and grow your wealth, hit that subscribe button. Thanks for watching, and take control of your money before someone else does.